In my last video, I talked about the value of a company shares. I talked about the book value and the market value of a company shares. And in that video, we discovered that even though the book value per share for Apple Inc. is about $4.47, the price you can actually get those shares in the market is about $203 per share. And for you to make sense of this information, that is the book value per share and the market value per share, you need to get what we call the price to book ratio. So what this ratio does is that it compares the market value of the company shares to the book value of these shares and helps you determine if these shares are overvalued, if they are undervalued, or if they are just fairly valued. In simple terms, what I'm trying to say is that this price to book ratio, it compares the price you are paying for those shares, that is the $203 we'll be paying for Apple shares, to what you can actually get from the company for each of your shares. If the company decides to liquidate today and settle its shareholders, what are you getting for your shares? So it compares the $203 to the $4.47. And with this, you can determine if you are paying too much for those shares. If you are paying too little, that is if the shares are too cheap and you need to buy more, or if you are just paying the fair amount for those shares. And then you can decide if you need to buy more of these shares, sell these shares, or just maintain your position. To get this price to book ratio I've been talking about, all you need to do is to divide the market price per share by the book value per share. I explained this in more details in the previous video, so you can check that out. In the case of Apple, which was what we used as an example, all you need to do is to say the market price of Apple per share, which is $203 as at the time of filming this video, divided by the book value per share of Apple, which is $4.47. And that will give us a price to book ratio of 45. So this means that Apple shares are trading at a price 45 times higher than what the book value actually is. And this reflects the fact that investors have attached an extra value to this company. And there is no specific range of what a price to book ratio should be. It could be high, it could be low. But if a price to book ratio is greater than 1, it means that extra value has been attached to that company. And it could be because the company has a unique technology, the company has great efficiency, or the company has future earnings potentials. So these are the kind of things that cause investors to attach extra value to the company's shares. However, sometimes if this price to book ratio is significantly high, it could just mean that the shares are overvalued and we are just paying too high for nothing. And it will only take a matter of time for other people to realize that these shares are overvalued and start dumping the shares. And when that happens, the prices of these shares will decline and you might lose your money. There can also be situations where this price to book ratio is lower than 1. For example, in the case of General Motors company, the price to book ratio is currently around 0.7 and 0.8, which is less than 1. So this can be a reflection of the fact that there are concerns around the earnings potential of this company. There are concerns around the debt to equity ratio, which is currently high. And then the revenue of this company has been lower than expected in recent years. But on the other hand, it could just simply mean that these shares are temporarily undervalued and they are cheap for you to get them now before the prices start increasing again. But you have to bear in mind that there is no specific range or number that helps you know if a price to book ratio is too high or too low. But for you to make sense out of this number, you have to compare it with the price to book ratio of other companies in the same industry as the company you are looking at, or compare it with the price to book ratio of other companies that are of the same size as the company you are looking at. So when you do the comparison, you check the company you are looking at and see if this price to book ratio is too high compared to others, which is an indication that it might be overvalued, or if it's too low, which is an indication that it might be undervalued. And you also have to bear in mind that no single metric or no single ratio can give you a definite answer on whether you should buy or sell a share. You have to compare it with other factors like returns on equity, growth, earnings growth, industry competition, or even market sentiment and other factors. You need to consider all of these factors so that you can be able to make a more investment decision on whether this company is fairly valued or not and whether you should buy or sell these shares. Now, let me know in the comments what other finance or investment terms would you like to understand, and trust me to make it simple. Don't forget to like and share this video. Follow for more finance made simple, and I'll see you in the next one.